Hello friends, today we will be discussing again about another interesting aspect of exchange rate depreciation and some of the remedies which have been announced by Reserve Bank of India in its monetary policy. Prompted by newly emerging geopolitical risks and steep depreciation of INR and depleting Forex reserves, RBI's monetary policy of June 5 has shifted its entire focus to increase Forex resources by using some unique non-conventional policy measures. We know very well that the Indian Rupee has depreciated by roughly about 8.45% to 10.96% against the US dollar after the outbreak of the war in West Asia on February 28. The INR was at 85.53 US dollars in March 2025, which fell to a low of 94.71 to 97 per US dollar by March 2026. This occurred despite RBI selling 53.1 billion in the spot market during the financial year to ensure the currency's orderly movement. Among causative factors, FPI outflows since January 2026, totaling to about 13.7 billion, primarily in the equity segment, hastened the depreciation of the INR. The depreciating INR and depleting Forex reserves, which fell from an all-time high of 728.49 billion in the week ended February 27, 2026 to 682.32 billion by the end of May, led the RBI to shift its focus of monetary policy to augmenting foreign capital by exploring some of the non-traditional policy measures. The most important and impactful has been the GSEC market liberalization. RBI liberalized foreign investments in government securities under the fully accessible route, which is known as FAR, and expanded the universe of Indian bonds accessible to global fixed income investors, particularly long duration investors such as pension funds, sovereign wealth funds, and insurance companies that require very long dated bonds by including all new issuances of 15 years, 30 years, and 40-year tenor GSECs in its eligibility criteria. In addition, limits on the short-term investment, concentration limits, and individual securities for FPI investment under the general route are being removed. If FPI can access Indian bonds at a lower tax cost, the risk-adjusted yield improves, making India more competitive in global bond allocation and attracting a durable inflow of expected to be around 10 to 15 billion from long duration institutional investors over the next 12 to 18 months. So this particular measure is expected to garner additional foreign exchange inflows into the country over a little longer period. Going beyond this, the next liberalization has been the NRI OCI investment norms. That is, the limits for investment by NRIs and OCIs, overseas corporate investors, in equity instruments traded on the stock market without SEBI registration are being increased. So this removes further the same facility is being extended to all individual persons resident outside India on par with NRI and OCIs in conjunction with the government's move to make the country's debt market more attractive through tax exemptions for foreign investors investing in Indian bonds. So the second one is the liberalization of investment opportunities for NRIs and OCIs, which will not require any registration with SEBI henceforth. The third aspect which has been proposed now is providing swap cost against ECBs to be raised by PSU entities. RBI provided a facility for concessional forex swaps until September 30, 2026 to incentivize PSUs to issue ECBs, to PSUs to raise ECBs and borrow directly from international markets, thereby generating foreign currency inflows that supplement India's forex reserves. PSU oil companies particularly and infrastructure entities, power generating companies have large ongoing capital requirements that can be met through international borrowing using the route of external commercial borrowings. The concessional forex swaps facility effectively subsidizing hedging costs for PSUs to use the ECB route, thereby reduces the all-in cost of foreign currency borrowings. This measure is available up to September 30, 2026, and it is expected to add about 3 to 5 billion in additional dollar inflows over a period of time. So this is what is expected. This is the third one. The fourth one is a big one that RBI proposed extending the facility to cover full hedging costs for authorized dealer banks until September 30, 2026 for raising fresh 3 to 5 year FCNR deposits, that is FCNR B deposits. Forward premium for hedging the exchange rate of FCNR deposits currently workouts to 3.5 to 4%. FCNR B deposits are also exempted from CRR and SLR. As a result, banks are expected to mobilize fresh FCNR deposits can be in the range of about 35 billion, that is what is expected, from 32 million NRIs by September 30 by offering an additional 150 to 200 basis points in interest to attract them. So, banks will be in a position to give concessional interest, preferential interest rates to FCNR depositors, and they can raise funds from NRIs residing abroad. It is expected that there are about 32 million NRIs residing abroad, which will be a very potential market for some of the banks which are having lot of overseas presence, like State Bank of India, Bank of Baroda, and many other banks which are having good presence in overseas centers. For every 1 billion of FCNR deposits, it is expected to flow rupees 9,500 crores in the form of liquidity into the banking system. If it is as expected, if 40 billion can be mobilized by banks through this FCNR route up to 30th September, then the resources at the disposal of banks for lending can also increase by about 3.8 trillion. This is a very potential resources to increase the lending scope of the banks. Fifth and the final point is restoration of realization period for export proceeds. The time for realizing the US dollar export proceeds has been in between increased to 15 months, is now being restored to 9 months, ending the previous temporary period of 15 months which was given as an extension. This RBI move aims to accelerate foreign exchange inflows, improve liquidity in the forex market, and strengthen India's external sector global uncertainty. All these well-targeted policy measures, if they can work, then it is expected that the foreign exchange resources into the country can be increased by about 55 to 60 billion over a period of time. If all these 5 measures which have been now allowed. And another aspect is India has been entering into trade agreement with various countries like New Zealand, recently with Oman, and then UAE, then even UK, and then US negotiations are on now, and it is expected to be completed very soon. If all these also open up new opportunities for exports, then I think the inflows of foreign exchange resources can be improved. And it is expected that the INR, which is now in the range of 95 to 97, is expected to appreciate to rupees 90 per dollar in the coming times. And the foreign exchange reserves, which are at 683 billion now, can also reach the mark of 750 billion. That is what the market expects. So, on the whole, the monetary policy of RBI on June 5th has totally focused its attention on providing a different policy liberalization to ensure that more forex resources can come back into India to provide the kind of support that is required at this point of time when FPI, the outflows of foreign exchange resources has been very high in recent times. In the coming times, I think it will be able to improve with these policy measures. So we'll be talking more about these kind of developments in the BFSI sector. So for the time being now, wish you all the best. And if you have not yet subscribed to this channel, please do subscribe and share this information with your friends and ensure that the knowledge dissemination goes on from one channel to another channel. So all the best to all of you. See you again.